What's going on, guys? It's your bro Taylor here.
No.
What is happening?
What's going on, guys? It's Ryan here from Two Bros and a Budget.
And your
No, dang it. That's the short. Dang it. Rewind.
Every time
All
we try
right.
to switch something up, our brain's short wire. I swear.
What's going on, guys? It's Ryan here.
Yeah.
No, I did. Oh man.
Oh no.
Okay, right into it. What's going on, guys?
Hold on, I'm still laughing.
It's your bro Ryan. Gosh. Okay, we got that funny business out of the way. What's going on, guys? It's your bro Ryan here.
And your bro Taylor. In this week's video, we're going to discuss some of the best dividend stocks you can buy and some that we personally recommend.
A few of the things that we like to look at when we're personally looking for our good dividend stock, a good dividend company, is going to be first outlook. That's one of the big things. Does this company have room to grow? So that's going to be one. The second is numbers. We're going to look at the PE ratio. We're going to look at the dividend ratio. We're going to look at historical growth, dividend growth. We're going to look at all those types of numbers. And we're going to try and go over that.
And of course, the price.
Way today.
Yeah. And just as a heads up, guys, when you guys are looking for dividend stocks, because we always recommend you to do your own research, because, we're not, financial advisors. We're just doing this for entertainment purposes. Don't always look for the highest paying dividend stock, because a lot of these companies are going to pay a high dividend. Like, you'll find some that are like 15% dividends, and that's like insane. You're like, oh my gosh, that's great. They're really doing that oftentimes to cover up that the stock itself isn't worth much. So you want a stock that's, good and has potential to grow and has a decent dividend.
So just like always, we're going to get into the video, but we introduced this a few videos ago, and we're going to talk about our beer of choice for this video. So today I'm drinking a Earl Grey tea sour. We'll see how this goes.
And I'm drinking a honey orange triple that I have never had before.
Good little splatter there. Gotta love it. Oh, got a little bit on the computer, but that builds character, doesn't it?
Delicious.
Is it, or did you cringe?
I may have cringed a little bit.
That's a good little color, too.
Yeah. Okay. All right, so we're going to go ahead and get into the video here, guys. The first stock or dividend paying stock that we recommend is CVS. Now, looking at the outlook, there's a lot of positives. Everyone knows who CVS is. But, a lot of people are turning to drugstores for vaccines, tests. I know take-home tests have kind of shut up, so, people are going to stores for that. This new variant, while, it's super transmissible, so kind of number of hospitalizations is still up, it's not causing as many serious, hospitalizations. People are staying in a lot shorter time period. So it's like causing less of a financial strain on CVS's health insurance side of the company, which is called Aetna, I believe it is. I'm not sure if I'm butchering that name or not.
Aetna.
Yeah, Aetna, sure. But, those are some of the things. CVS has some big plans for the future. They're trending more towards these health hubs, they're calling it everything, and they're going to plan on offering all sorts of stuff, more healthcare. They're expanding their, telecommunications and telephone support. They're going to have stuff. I hear that some locations are going to have stuff such as yoga and mental health services and everything. So, yeah, there's a big outlook on that. I think that's a pretty smart way to go given the times and everything. Foot traffic through stores, is kind of on the down, kind of trending downward over the past years because everything's going online. So this kind of new service is beneficial.
With, the minute clinics they already have, that's almost perfect for a doctor's visit virtually. So a lot of people are talking about the virtual doctor space, or what do they call it? The telemedicine. That's going to be big.
Some
for the
people
future.
call it different things, but yeah.
Yeah, and that's going to be huge for the future. And with that, it's CVS to me is in one of those perfect spots, because I don't see a doctor's office or a hospital necessarily growing from that. It would be its own thing. It'd be completely separate. And a CVS could definitely take on that role. Yeah.
And some of the big news that a lot of people are focusing on is CVS is closing a lot of their retail stores. There's a couple different things that people are saying that might be because it's, there is a bit of an employee shortage, so simply manning these stores has become more difficult. But also, it can be looked at as a positive thing if they're trying to free up some of their debt that they have, because we'll be honest, they do have a decent chunk of debt. I'm not sure, if these leases are towards their end and everything, or else they're going to have to continue to pay or sell them off. But this would be a good opportunity for them to get rid of some of that debt they have. All these leases for all these storefronts cost a lot of money. So getting rid of some of these stores and everything could be a positive, but we'll see.
Yeah, I think a lot of companies are doing that
Yeah.
now with the pandemic and things slowing down and then maybe being hurt or maybe not being hurt, but kind of sliding in there while people are, like you said, there's less foot traffic. People are starting to make broker deals and basically sign off a lot of their debt. So that's kind of the outlook of CVS. We do see growth for them. And then when you're looking at the numbers, so we're going to try and show our screen recording in this video, and we're going to be using Market Beat. I don't know if a lot of you guys have used that. I personally use it a lot, but it has a lot of good numbers crunched, a lot of good data. The charts look good, and I like the analyst recommendations as well.
For sure.
Just looking at that. So right now, as you guys can see, the price right now, as we're recording this, is $103.51, which it's grown a good bit since the pandemic or the peak of the pandemic.
Oh, for sure.
But you expect that. And then as you look over here, you're looking at a PE ratio of 18.1. So the price per earnings ratio or the PE ratio, typically the market average is about 20 to 25. So anything under that theoretically is a buy. If you're simply looking off PE ratio, a lot of things come into play when you're looking at all these numbers, and you have to look at all that plus the outlook and everything we kind of mentioned. But that's a good determination that something is a buy or not. If it's like 150, then it's pretty much saying it's overpriced.
Yeah, for sure. That's one of the first numbers you can look at a lot of times to kind of get a gauge on it. Now we're going to discuss some of these stocks that have a PE above that number. So obviously there are exceptions to the rule, but that's a good kind of like first thing a lot of people can look at.
Yeah, exactly. And so dividend yield, you can see right here, is about 2.2 or 2.17. That's not bad. Typically, you're going to want at least 4%. In my personal opinion, I like my portfolio to average a dividend yield of 4%.
Yeah.
That's usually a good marker that I like to hit. And then if you scroll down a little bit here, you get a little bit more information. We'll click on chart, just like we were talking about outlook. You can also look at history to see if something's going to grow in the future or not. If it's kind of peaked, if it's on the way down, you always want to look at that.
Yeah.
So in this example, you can see this chart. You can see over time, CVS has done very well.
And another thing you guys can look at to kind of determine if the dividend rate's good and everything is you can look at free cash flow. You can look at the free cash flow of these companies. And for CVS, it's definitely way up over the past few years. And that's a pretty good indicator that they can, in fact, afford that dividend. So, they have a healthy history of the dividend and everything. But looking at the free cash flow, it shows, hey, we can also afford this. Their revenue numbers are up over the years. They've made some acquisitions over the past several years. And their numbers are still going up, which is a pretty good indicator. There are exceptions to this rule, but pretty good indicator that these were good acquisitions. They're not suddenly bleeding or anything.
And the last two things we'll show for CVS are you can click the dividend tab and scroll down a little bit, and you can see that their annual dividend is $2.20, which is pretty good. And then you can also see its dividend increase track record. So usually you're going to want, right now it says 1 year. Usually you're going to want more than that. You're going to want to show that historical growth, not just in the company, but also in the dividend itself, because you want dividends to pay you consistently, but you also want them to grow over time. Otherwise, inflation and all the expenses will catch up to it. So you still want the dividend to grow as well. And then lastly, we really want to show is that dividend payout ratio. You usually want that to be below 60 or 70, depending on the type of the company or the sector. So CVS is currently sitting at about 38.5%, which is very good.
Yeah. So overall, we think CVS is a pretty solid buy. Although, people are looking at Walgreens as well. Walgreens is putting up very similar numbers to CVS. So those kind of, convenience store, health provider space companies are pretty good right now. This one, we chose CVS, which I personally think it's a really good outlook. And it's well priced right now. Looking at a lot of the numbers, some stocks are kind of overpriced now. I think CVS is pretty well priced, especially considering their outlook. They're trending more towards that healthcare space. less towards the retail, which I think is good for the future. That's just the way things are trending. Their PE is good, revenue's up, free cash flow up. There's just a lot of good indicators. The dividend may not be quite as high as a lot of people like, but it's one that they can afford and it has a good history. So I think it's a solid stock. And the next stock we are going to get into is one I think everyone knows and is one of the most famous dividend-paying stocks. It's CocaCola. Warren Buffett talks about this one all the time as a stock he highly recommends. It's one we're recommending too. It's never a bad thing to agree with Warren Buffett, I think. But outlook, maybe not quite as exciting as a lot of, let's say, tech companies and everything, because Coke is a super well-established brand. They're the biggest non-alcoholic beverage vendor in the world. This is a multinational brand, but with that you get a lot of stability and everything. So Coke is well established. They plan on they had I think a company release a couple months ago, I believe it was, that they plan on like pushing more of their smaller brands, because you'd be amazed all the drinks Coke owns. You don't really think about it, and I can't list them all. Maybe I'll put them on the screen, but they own so many brands and they plan on pushing that more. So you're not going to see quite as much like rapid growth in Coke, because frankly there isn't too much room for innovation like let's say with more of these tech stocks and everything. So it's going to be a much slower burn, but they are well established. Their dividend history is great, and if we look at the numbers, it'll kind of tell you that.
And so looking at the numbers, like Taylor said, so Coke, as of right now, recording this video, is just under $60, $59.96. And then if you scroll over or look over, their PE ratio is 29.39. So based on what we said earlier, between that 20 and 25 mark, theoretically looking at PE only, this is not a buy. Yeah. But if you're looking at some of their other numbers, like which we're about to show, it is a great buy at this price potentially. So looking at the dividend yield right under that, it's 2.78%, so just under 3%. And then we'll go over to the chart and look at its overall growth over time.
Yeah. And while, again, that is kind of a lower dividend than a lot of people are looking for, it's going to be constant. And if you invest a lot of money, you're going to, constantly get that flow in. Their free cash flow numbers are up. Their revenue is down a little bit over the pandemic and everything. Some things kind of wavered, but their profit margins are actually up. So profit growth is up while revenue is a bit down, which is a good indication of a great company and everything. And people are expecting revenue to go back up. A lot of analysts are saying that, so I'm not too worried about the revenue side of things. But their numbers are looking pretty good, and they have a good assets versus liabilities ratio. So a lot of good outlook on the company numbers-wise.
And it's I'm not gonna lie, it's honestly hard to find great companies just because there's so much that goes into it. There's so many numbers you have to look at, so many reports you have to look at. You have to follow the news with it. There's so many things that goes into it that it does take a lot of work and a lot of effort and a lot of knowledge to do this. Not saying that should scare you or make you shy away, but just like we always preach, is education is king, knowledge is king, and it's only scary because you don't know. It's the unknown. So you want to dive in and find out all this information, learn all this, because it's easy to be a great investor when it's a bull market. Yeah. When it's a bear market is when you're going to really see who can read a report, who can really understand these numbers, and that's what we're hoping to do here, is teach you guys a little bit about all these numbers and what they mean and their base behind them and why we're looking at them. So looking at their chart, you can see over time, Coke has definitely grown. And then going over the dividends tab, right now I'm doing more of the talking about the numbers just because it's on my computer recording this, so that's the only big reason. Taylor's mostly talking about the other section though. So if you look at this is huge. So dividend yield about 2.8. As we said earlier, it was about 2.78, I think. Annual dividend is 1.68, $1.68. I don't know why I said it like that a second ago. But the big thing to see here for Coke that everybody, including Warren Buffett, loves is over the last 60 years, 6-0, Coke has continually increased their dividend.
Oh, yeah.
Which is insane.
And if you couldn't tell by Ryan's tone, that is not a super common thing, guys. So that's a great number right there, or great news right there.
Yeah, honestly, one of the best. And their dividend growth is 7.7% or 7.69%, which is also very good. Their payout ratio is red on here because, like we said, You really don't want to go past 70, and 70 is pushing it a little bit. You really want to be between 60 to 60, or less than 60 to 65% payout ratio. But right now they're sitting at, with the pandemic and with their everything they had, their expenses, everything going on, they're sitting at about 82%.
Yeah.
Which is definitely a little high.
Yeah. And some of these numbers are a reason why some people think it's slightly overpriced. Some people saying it should be more ballpark. $50 would be a great buy-in price if you're looking to both get a good growth value and dividend value out of it. But if you're looking at a dividend stock that you can rely on, I personally wouldn't be afraid to buy right now at this like about $60 price range. So,
and the last thing I didn't mention on CVS, but after you're looking at all the numbers, kind of get an opinion in your mind of, do you like this company where they're at? Do you want to buy, or even give yourself a number? Look, if they right now they're sitting at about 60, if they drop to 55, I'm buying. You can look at this tab, analyst ratings, and you can look to see, look, there's 14 analysts, and right now it's a buy. So it's barely, but it is sitting at a buy. It tells you the price target they think Coke will be at or should be at. And then it gives you all of their ratings. So how many of them put it as a strong buy, just a regular buy, a hold, and sell. According to this and where their current price is, they're right at pretty much where they should be. So if they were to drop, this would go up the meter and become a strong buy.
Yeah.
It would fall in that PE ratio, and everything would look good. If it goes up, obviously it would fall out of buy.
Yeah. But moving on, the next one, another huge company that everyone's heard of, Apple. Now, Apple, looking at the outlook, is phenomenal. They're a constantly innovating company. They're one of the most powerful brands in the world. Apple is a status symbol, you know. The demand for iPhones is only going to continue to rise and everything. They've developed an ecosystem of technology that is great at retaining customers. Once you're in, you know, you're kind of stuck there, for lack of a better term, because you know they got the iPhone, the MacBooks, the AirPods. They have created any technology you would need to kind of sync with the other ones. They've created it, and they're a constantly innovating company. You know, they're talking about coming out with a car and everything. So, and they've entered the streaming service game, which you know is of course blowing up over these past couple years.
Ted Lasso's a great one, by the way.
Yeah. Over the past couple years, streaming services have only been blowing up. So they're constantly innovating. People think they're going to infiltrate a bit of the health space with your Apple Watches. You know, there's
totally see it.
Yeah, people are talking about all sorts of different features with that, like a blood sugar monitoring system and everything. So there's so many different things.
Yeah, they already have a mobile EKG, which is insane.
There's so many spaces that Apple is getting into and have already so well established themselves in. The Apple Outlook, I feel like I wouldn't even need to go over the Outlook. Everyone kind of knows Apple is Apple. Yeah. They are constantly innovating. They're one of the biggest tech companies in the world.
I think they're not only the biggest tech company, they're the largest company in the world based on market cap.
Hit a few trillion the other day, no biggie.
Just like you said, you're almost like stuck, but even better than that, you want to be in that ecosystem. I personally try to fight it all the time because sometimes the prices, you pay that premium for that brand, you pay that premium for that ecosystem, but it's the best ecosystem by far.
It lasts long. It's so well done.
Yes, the lifespan of the products, the quality of the products, the everything down. They think about everything, all the small details. So I've constantly tried to get away from the iPhone, and I look at it and I'm like, just doesn't make sense. Like I know I'm paying more, but at the same time I'm getting more. I'm definitely getting a better quality product. And I used to have a Mac for the longest time. I actually bit the bullet and went against the Mac, and I took a shot out of the dark because I hadn't had anything but a Mac, and man, do I regret it. Like, oh my gosh, I regret it more than anything. So they have such a great ecosystem, such a great quality product that I know they got one customer for a very long time. So
yeah, for sure.
Looking at some of the numbers though, they're sitting at a little bit pricier, depending on what kind of platform you're on. I know Robinhood, I know Webull, I'm pretty sure Charles Schwab, all let you buy partial stocks. And so in this case, $161.62 looks a little bit pricey. But being able to buy a partial share, you just want to be able to own that company for a long time and get that dividend, even if it's a partial for the time being.
Oh yeah.
And then we scroll over to your PE ratio. According to the PE ratio, sitting at about 28.76. Again, it is a little pricey. However, there are companies definitely that are out there that are sitting at like well over this. So
Yeah.
this really isn't that crazy.
Yeah.
Being
Apple
just
is a
over
company that seems to
mark.
constantly be exceeding expectations. So these numbers, is something that I personally am okay living with. I don't plan on selling Apple. They're with their innovation, and every time they like drop a new product, they're gonna shoot up like they did in the past few months and everything. So, all their numbers are okay with me personally.
Yeah, and the only thing that I would say I don't like about them number-wise is their dividend yield. Dividend yield being at 0.5% is pretty horrible.
Yeah.
So that does, like, it's a great company to own, and I do personally own multiple shares.
Same.
And I would recommend owning. If I could say, like, buy this, and I was telling someone that, I definitely would. But at the same time, Apple's it will bring down your overall portfolio's dividend yield, just because it's so low.
Yeah.
But so if we look over at the chart, which again we want to keep looking at, not only outlook, can this company grow? And they're the largest company, but they are just starting to get into the automotive space.
Yeah.
They're just really they have been into it for a little bit, but the health space, they have so much room for growth, and I think that market or that sector in general is just going to be so much bigger
even
than
some
it is
smaller
today.
stuff like AirTags and Apple Pay. They're kind of changing things all throughout the space. They're just
They were the
a great
first
company.
biggest, best smartwatch.
Oh yeah.
They were the first biggest wireless headphones. They've just done so many things so well, and started off first. Not a lot of times it's not the invention, it's the innovation, but they've done both. So they're just a very good company.
Without a doubt.
And then if we're looking at the chart, like we said, I like these tags up top, just the 5-day performance, 1 month performance, 3 month performance. And you just kind of see how they're performing over the years and over time. And then we're looking at this chart, and as you can totally see off the bat, just pure growth, like from almost nothing to all the way what it is now. They've just done nothing but grow with their innovation and what they've done. And then scrolling over to dividend. So again, 0.5%, 0.54 dividend yield is so bad, and the annual dividend 0.88 isn't great, or 88 cents isn't great.
Yeah.
But it's a company that you can rely on, like we said. 10-year track record of dividend increases. So they'll continually increase it. Imagine buying Apple at 160 now, and in the future when they're really valued at 300 a share, you're like, wow, that's great. I've almost doubled my money.
Yeah.
But at the same time, over time that's been double, or getting to that double mark, the dividend doubled. So you also bought it low, and now your dividend's up to $1.70, and you're making that money from it.
Yeah.
Every year or more, depending on how many shares you have, especially if they're reinvested. And then you can see this 3-year dividend growth, almost 23%, and their payout ratio, 15%. So not only are they outperforming everything, but their dividend is continually increasing, and their payout ratio is so low. That means no matter what happens in the market, for the most part, they could easily just pay that out no matter what.
Yeah.
That's why they were able to increase it, and they were able to continue that payment throughout the entire pandemic.
And if you look at their some more of their numbers, their revenue is increasing, their profit is increasing, so their margins are growing bigger. And the way they invest their capital into their own company, they get such a great return. Every time you look at, like, they dump a bunch of money into the company, their value just shoots up. They are handling their company so well. They have a great assets over liabilities ratio and everything. So all those things considered, some may say it's a little overpriced right now, but the outlook on Apple is so strong that I think it's a solid buy.
Yeah, and to Taylor's point, if you look at their analyst reviews or their analyst ratings, they said the price target should be closer to 180. So according to that, they're undervalued. And there's 31 analysts that reviewed this or rated this stock of this company, 25 of the 31 say buy.
Yeah.
25. That's great. That's insane. 13 say hold. 2 say sell. I don't know who those 2 are, but they might be out of there. I'll say rocker.
Yeah.
But
those are the super
when
cautious
say,
guys who are going to miss out.
Yeah, and when you see this, you can see. Actually, I was looking at the wrong one.
And besides,
So
us 2 here, we cancel them out.
I was looking at the wrong one twice. I was looking at 1 year ago. But that's what I was just going to say is you can see like how often they update this. And the current one actually says 2 people are strong buy, 23 are just a buy. And then you have 5 that are hold and 1 that sell. So only the 1 that sell. But that price, look at this. Just a year ago, they were saying it should be around 120, and just a year from now, they're saying about 180.
Yeah,
that's
they're
crazy.
constantly exceeding numbers.
Like you can see that. You can see that just from the reviews.
Yeah.
And yeah, it is definitely a great company. And the things we're pointing out, the PE ratio, dividend yield, are just very few of the numbers you should look at. We're just trying to give you guys the highlights or quick determinations if a company's typically good or not. This is never the end all be all with just these few numbers.
And while we are recommending these stocks, we are not professional financial advisors and everything. This is just off what we personally own, personally would recommend and everything. These are just companies we really like ourselves. But if you guys like this kind of video, I know these were somewhat expensive stocks, Coke being the cheapest one. If you'd like us to go into some other, smaller, cheaper dividend-paying stocks that we kind of recommend, we can. But this video is already kind of long, so we figured we cut it at the 3 big ones that we recommend the most. But if you guys want any information on growth stocks or more dividend stocks, please let us know in the comments. We always love hearing from you guys.
Now the beer review.
Oh, yeah. All right, so this New Belgium.
No, we got to save Taylor's for last because he's finally into the beer reviews. He skipped the past 2.
I missed 1 or 2. Goodness.
So, this is like I said, the Earl Grey tea sour ale. Sours, I do like sours. They can vary. Sometimes they're too sour for me. This one's pretty sour, but I do like it. And I could drink probably 1 or 2 of these. I would say this is a solid 6.5.
This New Belgium triple, I actually like a good bit. My initial reaction was a bit off because it's strong. It's like 10%, so it's a strong beer enough, but it's got just a little hint of sweetness to it. I would recommend. I'd say it's like, for me, maybe like an 8,
Wow.
maybe a little bit above. I actually really like this beer. I could drink definitely a few of these.
Put you down?
Yeah, right?
A few of them at 10%. I like to see that.
Yeah, I actually really like.
Our
I
viewers
think the
would
flavor
too.
is really
We'll take
good.
a video of that.
Yeah, so I would definitely recommend this beer along with all these dividends. Maybe once you buy these, crack open a beer that we recommend as a little treat.
Yeah, that would be awesome if we started recommending beers and you guys took videos or said a comment like, hey, crack that open for the first time and blah, 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 I like this, or I didn't like this one. That would be awesome if that actually turned into a thing.
Yeah, any type of feedback you guys have, please let us know in the comments. We are super open to any information that you guys have about our channel or any questions you have.
I don't know if we mentioned it in the last videos, but we did just open up our Twitter. We're trying to get more active on social media and on Twitter. So you could always just comment on there. You could always reach out to us on there.
Yeah.
We also got more active on TikTok. We've been posting a lot of videos on TikTok. And we're going to, as we grow the channel, we're going to try and find the time to keep growing on other social medias and be more interactive with you guys.
And we're the same name on those different things. We're 2 Bros in the Budget. Hopefully you guys can find us. We'll put our handles across the screen here too and put them in the description as well so you guys can find us. But thanks for tuning in this week, guys. Again, please like and subscribe. We're trying to grow this channel as quickly as possible. But be sure to tune in this week. We're going to keep trying to push out this new content to you guys.
Yeah, we appreciate you guys watching, and cheers, guys.
Cheers.